What can we learn from entrepreneurial history? We can rewind business models for an understanding of how they compete and how they require significant tuning and adjustment over time.
This is the Economics for Business podcast. We are here to help all businesses become champions for customers and value, improving lives with preferred and innovative products and services. We offer you the knowledge and tools to make your entrepreneurial journey a successful one. Now, here's your host, Hunter Hastings.
Hi, Hunter Hastings here. There's a special kind of history we call entrepreneurial business history. It's not the kind you read about in business biographies where charismatic individuals carry entire corporations and industries on their back in singular acts of business heroism. The goal of entrepreneurial history is not hagiography, but understanding, especially of business processes and business model design. This week, we have a fascinating business model history of multiple competing companies in an industry that is of recent origin and is still evolving in new ways. That industry is in-home viewing of movies. We can say that the beginning of history in this case is the introduction in the 1970s of the video cassette and the video cassette recorder machine, which also served as a playback device. This was the beginning of time-shifted home movie viewing, in which the sovereign consumer found a benefit and a valued experience. We'll hear about price discovery, the importance of operations and of inventory management, and long-tailed behavioral patterns related to inventory, availability, abundance, and scarcity. We'll observe two competing business models and the emergence of a third one. And we'll get some insight into the long-term superiority of a business model tuned to consumer value generation versus one tuned to shareholder value generation. The competing firms in this history may not be familiar to many listeners: Blockbuster, Hollywood Video, and H-E-B Grocery. The most recent emergent business model will be more familiar: Netflix and streaming video. But even Netflix had a big business model transition to navigate before getting to where it is today. And we'll learn definitively that emerging technologies do not undermine incumbent companies. It's bad business models that are their downfall, and the associated failure to recognize business model shifts and the inability to adapt. Our guest is Alan Payne. Alan is a Texas Tech marketing alum who was an executive at H-E-B, the Texas-based retailer considered one of the best in the world. He spent a lot of his time at H-E-B running Video Central, their in-store video rental business. He worked for Blockbuster for a while and ultimately made an entrepreneurial purchase of a chain of video rental stores, which he made into the most profitable in the industry. So he's seen the evolution of three business models firsthand. He's sharing his learnings in a great book called Built to Fail, which is both a warning about bad business models and a recipe for evolving a good one. Alan, welcome to the Economics for Business podcast.
It's great to be here.
Well, it's great to have you here. We're going to learn a lot today. You've written a book. It's called Built to Fail. It's so chock full of learning for entrepreneurs and managers at every level of business. It was hard to keep up while reading it. A torrent of insights. I made a note to myself. It's about Blockbuster and Blockbuster's life cycle from what you call hypergrowth and stock market darling to bankruptcy. And within that is about eras of management in times of change, shifting consumer preferences, technological shifts, competitive environment shifts. I think the overarching point is that those changes can be accommodated, they can be capitalized upon with good management, or they can be catastrophically destructive to bad management. So we're going to learn a lot of lessons today, Alan, as many as we can. We like to start with your context and your origin story and how you came to write this book. So why don't you start there for us?
Okay. Well, it's an important part of the story, I think, because I got into the business differently than most did. When I graduated from college, I went to work for a company called HEB. And for listeners, that's probably a name you're not familiar with. I know you're familiar with them because of your background, but HEB is a $30 billion grocery company in Texas, and they're far and away the market leader in Texas. They're dominant. In fact, the best example I can give of it is I remember when Kroger came to San Antonio back in the 80s, thinking that they could take over the market. They lasted about 10 years and left. They completely left the market. A lot of the major national chains have left markets that HEB is in because they can't compete with them. So I went to work for them and ran stores for them for about 7 years. And then they sent me to a program. I don't know if you're familiar with it, but there's a program at USC in LA called the Food Industry Management Program.
Mm-hmm.
And
It's
people,
famous.
companies send their people from all over the world to that program. And they sent me to that program in 1986. And spent a year there, and ironically, when I came back to HEB a year later, they had bought the company that was renting videos in their grocery stores, and at that time, that was a pretty big business back then. And they had a hard time finding a place to put me when I got back, and finally put me in charge of running the operations for the video business. And the main reason was because they had decided they were going to open up some freestanding video stores that competed with the Blockbusters of the day. They were the only grocery company in the country that did that. And they put me in charge of the operations of that. So that's how I got into business. And we ran those stores for 7 years before I left, and we competed directly with Blockbuster. We had a completely different business model than they did. So I learned the business in a completely different way than most people did back then. In a big company that had lots of resources, and even though as compared to Blockbuster, we were small, we were bigger than they were in our markets and dominated them and head-to-head competition. So the business model that we put in place was completely different than Blockbuster. And then HEB decided to sell those stores, not because they weren't doing well, because Charles Butt, who owns HEB, sold them for about $1 million a piece. So they were doing quite well, but he just decided that he wanted to put all of his focus back on the food. So he sold those stores to a company called Hollywood Video in 1993, who very quickly became Blockbuster's only national competitor. And part of that was because they bought our very successful stores. I wound up going to work for a Blockbuster franchise group in 1993 that only had 18 stores at the time. And 7 years later, they decided to sell them. This was in 2000. And I raised $16 million to buy those stores in 2000. So I came to the ownership of Blockbuster stores very, very late. There wasn't a whole lot of growth going on in those years. So I didn't make the easy money that the early franchisees did in the 80s and 90s. So I kind of had to fight for it more in the 2000s. So in short, that's how does that explain most of it?
Yeah, that's really great context.
Okay.
Thank you. And that gives people a great picture of where your knowledge is coming from. But let's now step back to the beginning of the video rental business. We probably have some listeners who don't even remember the video rental business. But one of the things I really liked about the story in your book is that it points out this business started with the very early kind of scratchy, scrambling efforts of a few local entrepreneurs. So let's start there.
Well, the first thing we have to talk about is that, and people forget this, but up until the VCR was introduced in the late 70s, people didn't have any ability to watch anything except when it was on television, on the network schedule.
Yeah.
Movies could be seen in theaters, or they could be seen on network television, years later. but the ability to watch something when you wanted to watch it, which sounds so yesterday now, but that was a completely new concept in the 80s. And the VCR is what created that opportunity. That's not why it was made. It was made to time shift, so people could record programs and watch them at different times. It was more convenient to them. Immediately, the Hollywood studios went after the legality of the VCR and sued Sony to try to stop the sales of it because they thought it was breaking copyright laws for people to be able to record their program. That went all the way to the Supreme Court and lost only by a 5-4 vote. So the VCR was almost illegal. After that, in fact, during the time that they were suing Sony, they also tried to introduce a law in Congress to ban the rental of movies because if they couldn't outlaw VCRs, at least maybe they could stop the rental of movies. That fell too. It never got to a vote. So throughout the 80s, you've got an industry that is by now a multi-billion-dollar industry. It's up to $3 or $4 billion by 1985, but it had not attracted traditional retailers or capital, primarily because the legality of it had been threatened, and also because even back in the 80s, people assumed that electronic delivery of movies would quickly put the video store out of business. Now, that didn't happen for, as we know, a long time later. Mm-hmm. But there was that fear that telephone companies or cable companies or somebody was going to make video stores archaic. So it didn't attract traditional capital. And for that reason, a lot of kind of ragtag entrepreneurs created the business. And a lot of them were not great business people. In fact, all of the early pioneers of the business failed pretty early on. They made a lot of money. The ones that did it right made a lot of money. But the moment the business got competitive, primarily with Blockbuster entering the picture, most of them either failed or sold their business to Blockbuster. There weren't a whole lot of them left by the time Blockbuster got up and running.
Yeah. But if I understand it right, Alan, the pricing model for rentals of movies did emerge from that phase, right? Tell us about that, how the studios priced the videotapes and the entrepreneurs figured out how to rent them.
Well, the studios, you know, they saw the VCR as a way to sell movies to customers directly to them. And believe it or not, they thought those movies were worth about $100. And this is in the 80s. And we all know today we can go out and buy movies for $10, $20. But back then, they thought that the right to own one of their movies that you could watch anytime and with as many people as you could cram into your living room, they thought that was worth about $100. The wholesale cost of that was about $65. So what happened is that a lot of these entrepreneurs saw that as an opportunity because no consumers were going to pay $100 to own a movie. Very few anyway. It wasn't a business as the studios wanted it to be. So a lot of them started renting them for usually about $3 a piece. And that is what that business model is what exploded. So you can just do the math of that. You got to rent a movie over 20 times just to get your cost back. So that business model was pretty much imposed on these early video stores by the price of the movie.
Yeah. I love the story, though, that the business model emerged from entrepreneurial effort as opposed to the studios.
Absolutely. Absolutely. Yeah. In fact, the first video stores opened in the late 70s, and you didn't get any companies of any size into it until the mid 80s. And of course, Blockbuster opened their first store in 1985, and within 7 years had 3,000 of them. And that completely changed the business.
Well, let's go there. So capital was attracted to the industry eventually, and it was in the form of a very big fish, as you say in the book. Tell us about that.
Wayne Heisenga, who many of your listeners probably haven't heard of, but the best way to remind people of him is he started Waste Management, which is with one truck in the early 60s. and that's still the largest waste company in the world. He got out of that business in 1984, 85, and got presented with the opportunity to invest in Blockbuster. And the reason was the person that had created Blockbuster, a guy named David Cook in Dallas, Texas, was kind of a data geek and computer geek. And he had come up with a way to computerize video stores. And again, that sounds so backward today, but at the time, most of the early video stores were run with paper. Most of them didn't even have computers because the personal computer was new to the world at that time. He had created this business model with a very large video store that he called Blockbuster, and designed it and everything, and was rolling it out. There was about 50 stores open when Wayne Heisenga took a look at it. And the reason he took a look at it is because David Cook was running out of money. It was growing so fast, and he couldn't raise enough money to keep up with it. So he was looking for a partner. And Heisenga and his partners bought controlling interest of the company in 1985 for $18 million. And David Cook subsequently left because they didn't see eye to eye on a lot of things. And I think it's interesting. David Cook, he sold his stock, and as he tells the story, he lost close to $400 million by selling his stock.
Wow.
Early on. He questioned whether Heisenga was going to be successful with it or not. So Wayne Heisenga was I guess the classic entrepreneur that saw things on a scale larger than most of us are capable of seeing. He saw the opportunity because of the way the business had been created, and really built a company that had the ability to finance and grow exceptionally fast. And from his perspective, that's all that was needed. And for the time period, he was right, because they had a business model that worked. It was much better than most video stores of the day. So as fast as he could roll them out, he was growing the company at an unbelievably profitable rate. And he was opening more than a store a day for over 7 years. So he understood scale. He took the company. It was a public company, so he kept going back to the markets for capital. Didn't have a lot of debt. He was buying competitors for 4 or 5 times cash flow, and his stock was trading at multiple times more than that. So he was just printing money with the more stores he acquired, and it was a steamroll effect. And it was phenomenally successful. I mean, he sold the company in 1994 to Viacom for $8.5 billion, just 7 years after he paid $18 million for controlling interest of it. So it was phenomenally successful.
Capital efficient in that sense.
Yeah.
A quick note: did you know that we provide supplemental materials for each podcast? Listening to and understanding the key takeaways from our expert guests helps you think better about building a more beautiful business. Taking direct action and implementing these strategies is when the real work begins. Take a concrete, immediate step to implementing a better business model today by downloading the show notes and business tool we've created for this episode. Visit Mises.org/E4Bpod. That's MISES.org/E4BPOD, and click on today's episode. Now, back to our interview.
But you say in the book that Blockbuster was growing, but it wasn't learning. It wasn't using the data that it was getting from consumers. It wasn't managing the business model or the inventory or anything else very well. They grew, but they didn't learn.
Yeah, they didn't. And we saw evidence of that before I ever got involved with Blockbuster, because I competed with them for 7 years. And as I tell the story in the book, it was very common for our stores to be doing 2 to 3 times the volume of a Blockbuster store across the street. So we knew they were vulnerable, and we knew, and what amazed us is that as successful as we were against them, they never responded. They never did anything. And we would just destroy any Blockbuster store that we opened up against. And later on, I found out that they had themselves convinced that we weren't making any money, that it was just this venture of a grocery company, and they thought maybe we would be happy with the 2 to 3% profit margin, which is typical of a grocery store. Well, that was not the case. Our profit margins are 20, 30%, just like theirs were. And so when I got to Blockbuster, I was just amazed.
Hold on a second, Alan, because
Okay.
I want to think about that issue for Blockbuster, that they weren't learning. In fact, you just told us they weren't assessing their competition very well, which is another fatal flaw. But you're at Video Central. You mentioned the leader of that business, Craig O'Danovich, and you said he was building a different business model, and he treated the stores as laboratories of learning. And a lot of it was operational learning, but some of it was customer experience learning.
Let's think about, we were backed by a grocery company. We had access to their entire distribution system. And we had access to all their resources. Again, we were much smaller than Blockbuster in video stores, but HEB was a bigger company than Blockbuster was. And so we tried everything. Within the first 2 or 3 years after we opened the first stores, we had tried just about everything that we thought had a chance of selling in a grocery store. We even had photo processing in some of our stores, because back then, that was a very big deal. HEB had its own photo processing plant. We thought that would work perfectly in a video store, where you had to visit twice to drop it off and to pick it up. It didn't work very well. Hardly anything would sell successfully in a video store other than snacks. And so we tried all kinds of things, and none of it worked very well. So we put all of our attention on how do we rent as many movies as we possibly can. And as you know, generating volume is not always about high prices. Many times it's about low prices. And that's how we approach the business. We wanted to create the best value we possibly could and have the best availability of movies that we possibly could. And back in those days, with $65 new releases, that was a challenge to keep them in stock. So
But then you discovered an innovation, which was the innovation, strange to call it, is old movies.
Yeah, and Craig had developed this whole idea is that and it seems so obvious, but new releases were, you could rent a new release for $3 or $4, but nobody viewed older movies at those prices to be okay. So we rented the older movies for $1, and we were generating enormous rents and a lot of sales from that product, and always considered it just as important a part of the store as the new releases, and rented them for 5 days, which was a novel idea at the time. All of our new releases rented for 1 day at a time. That was the more efficient way to do it. So I got to Blockbuster in 1993, and one of the first things I wanted to find out is, why did they price all of their older movies the same price as new ones? Because I always thought maybe they knew something we didn't know. And what I found out, they weren't even tracking. And this was kind of my first window into what Blockbuster was like. It was always extremely important for us to understand exactly what was renting on the floor, what we called movies in the middle. There was a lot of different names for it, but the older movies, the catalog. It was always very important for us to stay in stock on those and rent as many as we could. I got to Blockbuster and they didn't even have a means to measure it. They didn't even know. One of the first things I asked when I got there to my product manager is, tell me how much the drama category is renting in these stores. They didn't know. There was no report to show it. And so we had to devise ways with that and many other things to measure what we considered important in a video store that Blockbuster paid no attention to. So we came up with all our own systems to measure this stuff, and that was kind of the beginning of us creating a different business model within Blockbuster. We ran it completely different than they did.
Yeah.
Yeah. So
there's a couple of fascinating things there. You said it should be obvious, but it wasn't obvious to them. And so the innovation takes work. You discovered it. It wasn't given to you. You discovered that. But a big part of it is operational excellence. If you track your inventory and track your data and track your pricing and track your revenues, operational excellence translates into a good consumer experience. That's the fascinating part for me.
Well, we were, to me, I thought we were just following the customer. It wasn't complicated to us. If a customer came in and we could see all this evidence that they had a strong interest in older movies, if you had the right inventory and had it priced right, they would rent it. And after I kind of figured out what was happening when I got to Blockbuster, I found that we were renting 2 to 3 times more of that than a typical Blockbuster store was. Mm-hmm. Well, they didn't see that as particularly a good thing because it was renting for a lower price. They viewed it as a trade down, that a customer came in a Blockbuster store and wanted a new release, and that we want to rent them that new release for $3 or $4 instead of the older movie for $1 or whatever. They viewed that as a trade down that was hurting their business. From my perspective, and I was showing them the data behind it, is that we were renting just as many or more new releases than they were, but we were also renting all this catalog product that customers had a strong interest in. And it just never, I don't know why, Hunter, but they just never had an interest in understanding that. And that carried over into so many other parts of the business. It was just a lack of I call it intellectual curiosity. They just didn't seem to have an interest in it, and really never did. And those behaviors, even though management changed over the years, I don't think those behaviors ever did. And that's why later on, Netflix and Redbox and other people would hurt them so bad.
Yeah. Well, let's not go there quite yet.
Yeah.
You joined in a franchise group of stores. The same store results at Blockbuster are starting to decline, although they're still adding stores. But you were able to prove in your panel that you could bring in these innovations and you could create growth in existing stores. So tell us a little bit about how you did that, and then about why Blockbuster wouldn't listen.
Well, the great thing about being a Blockbuster franchisee is that you controlled your inventory and your pricing. The only thing that we were required to do as a Blockbuster franchisee is protect the brand.
Yeah.
But we could stock the stores and price it however we wanted to. So once I spent a couple of months once I joined that franchise group studying what was going on, and quickly realized that our business model that I brought there from Video Central and HEB, it was obvious to me it was far superior to what Blockbuster had created. So we installed that. We increased inventory, we reduced prices, we started renting new releases a day at a time instead of 3 days at a time. The business turned around overnight. I mean, it was almost instant. We had more customers in the store, renting more movies, generating more revenue at higher profit margins. In fact, the first year we had the highest same-store sales of any franchise in the entire company. Won an award for that year. You would have thought that Blockbuster would have had some sort of interest in that, but they had none. they never even asked us what we had done. And we had literally turned the Blockbuster business model of 1993 completely upside down. It just completely thrown it out and started over. But they never had an interest in it.
Yeah.
And I could understand if we weren't getting the results, but we were. We had within just a year or two, we had some of the highest volume Blockbuster stores in the world. Those in Alaska.
Mm-hmm.
So, but we never had a substantive discussion about what we did and how it was working. They just didn't have an interest in it.
Well, it's fascinating, this idea that two business models can exist in the same industry at the same time, that the shared knowledge is not doesn't flow easily, shall we say. And in fact, two business models existed in the same company at the same time.
Yeah, well, but here's what really, where the miss really cost them, is the business model that we had created at HEB was acquired by Hollywood Video.
Mm-hmm.
See, when Blockbuster looked at buying the Video Central stores at HEB, but passed. Didn't, in fact, as I tell in the book, I think it was their first really, really big miss. And that's one that nobody knows about. It was a long time ago. They could have bought those stores and it was pocket change to them. It was about $30+ million. They didn't. But a guy by the name of Mark Waddles, who was just starting Hollywood Video in Oregon, did buy those stores. And he had been studying our business model for a long time and understood how it impacted Blockbuster, how it worked. He bought our stores and within 5 years had over 1,000 stores all over the country. And that business model was virtually the same one that we had developed at HEB. And that business model, even though I was running it, same thing within Blockbuster, they didn't only ignore me, they also ignored Hollywood Video, never responded to it. And within 3 or 4 years after Hollywood had done that and expanded all over the country, Blockbuster was having financial problems. And this was in 1996.
There's a concept in our economics, Alan, we call it entrepreneurial alertness, that there are some people who are alert to opportunities and new business models and what's really going on, more so than others. And we can't explain it, but that sounds like Mark had an example of entrepreneurial alertness.
Yeah, I mean, Mark Wallace had seen how successful we were against Blockbuster, and he just basically did the same thing. Now, in many respects, I think his stores looked better, but his business model was essentially the same.
So at some point, Mr. Heisenga figures out that he can't transition from a growth company to an operating company, or maybe he didn't. Maybe it was just timing, you'll tell us. But he sold the company at the peak, as you've mentioned, to Viacom and Sumner Redstone. And what happened? What happened after that?
Well, he, for a lot of reasons, many we speculate on, but I think Heisenga thought it had peaked. As he said so many times, he's a builder, not an operator. He didn't have an interest in grinding it out now that the easy growth was over. Mm-hmm. So he was presented with an opportunity to sell Blockbuster to Viacom for $8.5 billion, and he did it. And within a few months, had completely left the company. The assumption on Viacom's side, they bought it for the cash flow because Blockbuster was an extremely rich cash flow company. They were generating, well over $500 million a year in cash. Viacom needed that cash to do a deal to buy Paramount, who they didn't own a studio at the time, and they needed Blockbuster's cash. And the assumption was that this Blockbuster just this juggernaut that was just going to continue to roll. But what they didn't know is that Hollywood Video was just starting to ramp up and was just killing every Blockbuster store they opened against. And so, as a lot of people said back then, Viacom bought Blockbuster for the cash flow, but the cash flow never happened. And they started very soon after Blockbuster, after that purchase, trying to get rid of Blockbuster and spun off 20% of the company to the public in 1999, and it was valued at $2.5 billion. So 5 years later, the value of Blockbuster had dropped by over half.
Yeah, amazing.
So that's how and Netflix hardly even existed at the time.
Yeah. Well, let's not get quite to Netflix yet. The first technology transition, which is starting to happen at about this time, was from video cassettes to DVD.
Right.
And I guess Netflix did come in then. But DVD changed the industry, Alan. But you said it was manageable for Blockbuster. They could have managed that transition. Think about that for us.
Well, just as the studios had imposed a business model on video stores with video cassettes, they changed the business model when they introduced DVDs in 1997, because the whole concept was to sell direct to the consumer. Don't sell it at a cost that consumers will not buy it, and it winds up for rental in stores, which created what we called the rental window back then. They were going to sell it retail it for $15 to $20 and sell direct to consumers. That completely changed the business model. And of course, it also dramatically reduced the cost to us to buy movies to rent. Well, the whole idea was that the studios thought that they could kill or at least really injure the video rental business by going direct to consumers to sell it instead of rent it through video stores. What happened is they basically flatlined the rental growth. I mean, there was a little growth here and there, but for the most part, it was stuck at around $10 billion. Still a big industry. And Blockbuster's got about a 40% market share of that. So, it's a $10 billion industry, and Blockbuster's got a fourth or 40% of it. So here presented with is this opportunity to increase your profit because they didn't succeed in killing the business. And Blockbuster amazingly managed to spend more for the product than they had when it was more than twice the price. And not only, and they did it through some unexplainable revenue sharing deals that they did with the studios. So a few years into the transition from VHS to DVD, Blockbuster spending more for product than they did even with VHS. And what makes it more complicated is that DVD was a great format, and it could be easily mailed through the mail. And that's what started Netflix in 1997. Right.
I remember those days, the red envelopes that came in the mail.
Yeah.
But let's stay with you and what you did, Alan. You took the entrepreneurial decision that I know how to do this. You took the opportunity to buy some Blockbuster stores yourself, that's a very gutsy move given what's going on in the industry. Tell us the Border Entertainment story.
Well, the stores I was running were owned by a cable television company called Prime Cable. Not one of the big ones, but they were significant. They owned the cable systems in Las Vegas and Chicago and Atlanta. I mean, they were a pretty big player. Very entrepreneurial kind of company. They bought and sold properties, and eventually they decided they were going to exit the cable business, and they also exited the Blockbuster business. And they came to me and told me that, hey, you got 90 days to put together a deal. We'll give you first shot at it. So this was right in the middle of when DVD was really starting to take over the business. I saw massive opportunity. So we raised $16 million to buy those 25 stores at the time. And it was only because we believed DVD was a huge benefit, while Blockbuster was treating it as a threat. So we used DVD over the next 7 years to triple our profit in the company. And in those same 7 years, Blockbuster basically went broke. And I think the big thing is we viewed it as a race to move, and I'm sure this happens in a lot of businesses, but if you think about a Blockbuster store of that day, they were built to stock about 10,000 VHS cassettes. That was basically the standard inventory of a Blockbuster store. So as you had these VHS customers transitioning to DVD, and keep in mind that took about 7 years for that to happen, you had to keep your VHS customers happy, and you had to keep your DVD customers happy in a store that was designed for one format. So we viewed it as a huge challenge that needed to be taken on head on. Otherwise, we were going to lose those VHS customers to Walmart, which was essentially a new competitor because they were all being sold there at the same time as we were renting them. So we viewed that as a huge challenge. So if you were to walk into one of our stores back then, half of the store would be VHS and half would be DVD, because we viewed those customers, and we believed we had the evidence to back it up. Once a VHS customer bought a DVD player, they were a DVD customer. They were not a VHS customer. So it was really important that we moved those people successfully from one format to the other. When we started challenging Blockbuster on that whole concept, they told us that the customer was format agnostic. That, in other words, they would go spend $200 or $300 for a DVD player and come in the store and not really care if you had the DVD or the VHS.
Doesn't sound right.
It just didn't make sense. It didn't make any sense to us.
Yeah.
So we treated that conversion very, very seriously. Spent a lot of money. Not only on the inventory, but adding fixtures to the store so that we could stock it all. And so that whole process of transitioning the customer of 1997, which was the year that DVD was introduced, to DVD to completely converting over the next 5 or 6, 7 years to DVD, that was a huge challenge. And Blockbuster never really took it very seriously, and they never invested in the DVD inventory they needed to transition those customers from VHS to DVD. And the frustrating part to me is everything in the world was being attributed to Blockbuster's problems back then, but Wall Street analysts didn't understand. I mean, it was a fundamental miss of not even reinvesting in your inventory when the customer was moving to a completely new format. Blockbuster never did that. They never committed to it.
One of the most important lessons I took away from that part of the book was the learning platform, the ability to learn about consumer preferences, whether it's format or content. In your principles of business conduct in the book, you put customers and customer experience first and foremost, and I was delighted to see that. And then kind of in parallel with that, you said what Netflix did ultimately was build a better vehicle for learning about customer movie viewing experiences. So that's how they won in the end.
Yeah, I think it's a great story because Blockbuster, if you think about it, during the 90s when the business was growing, they accumulated more behavior data on movie viewing habits than any entity in the history of the world. If you think about it, they knew the demographics of every renter and everything that they rented. They had much more information on who watched what and why than even the Hollywood studios ever had. Yet we've got this upstart Netflix starting a business in 1997, mailing these DVDs to people, and I think the most important part to take away from how all that came about is Netflix, because they could not efficiently get new releases to their subscribers the way a store could, because it spent a lot of time in the mail and in processing. because most of the demand for new releases is eaten up in the first 2 or 3 weeks. There was no way that Netflix could do that as efficiently as a retail store could.
Mm-hmm.
They might rent something once a week or twice a week, where a store would rent it 3 or 4 times a week. It was a real weakness, and Netflix acknowledged that. Well, what they did is that as they were learning the business, they figured out how to match up their subscribers' taste to older movies, to keep them happy renting them older movies instead of new ones, because they knew they couldn't compete as well on new releases. So I think it was just a natural evolution of how they learned the business. They figured out that they had to understand the taste of their renters more than Blockbuster, because their business had to be predominantly older movies, not new ones, which was typical of a corporate Blockbuster store. All that they learned in that process is, and that's the reason Blockbuster never understood Netflix. They didn't understand that Netflix, only about 20% of what they were mailing their customers was new releases. In a Blockbuster store, it was 90%. So they didn't understand the Netflix customer, and in many ways, they so viewed it as a new release business that they didn't take Netflix very seriously. And what happened is Netflix builds this juggernaut of keeping people happy by sending them older product, and we still see that in streaming services today.
Yeah, I think you can put a little bit more of a customer intimacy kind of view on that, Alan, that they learned, perhaps accidentally, but they learned there are horror movie buffs and there are comedy buffs and there are musical buffs, and that there's a segmentation out there. And if you understand your customers well, you can capitalize on that segmentation.
Right. And they did a masterful job of it. They really did.
Yeah. As you say, they had the data and they were able to learn from it.
Yeah.
Let's get to the lessons learned section of the book, Alan. I'm just looking at the clock a little bit here. It's particularly valuable. I urge people to buy the book because we can't go through all 7 of them. But I like the first one that you put in the most prominent position is know your mission, and number 2 is know your key drivers. So let's riff on that a little bit.
Well, I think in my opinion, corporate mission statements get a lot of lip service. At least they did at Blockbuster anyway.
Mm-hmm.
Blockbuster had a mission statement. It was be the worldwide provider of movies or whatever. I mean, it was just a generic statement that didn't really mean a lot, and it didn't get to exactly how they were going to do it. So I did, and I'll go back to grocery days. Grocery is viewed as kind of a mundane business, but it was, we always felt like we were on a mission because we were the provider of food to our markets, and it was important, and we had to be the best at it. And believe it or not, renting movies was not comparable to providing food, but the fact is that over half of the households in America were going to a video store every week for over 2 decades. It was a part of life, and we all and in fact in our stores we were the number one way people watched movies at home, and we could do the math on that. It was a lot bigger than anything than theaters. It was a lot bigger than pay-per-view through cable and stuff. So we always viewed that as a mission, that we were important to the communities that we serve, because they relied on us to have the movies they wanted to see. So it was important, and I think that led to, okay, well, how can we do that as best as we possibly can? And we learned some of how to get better from competition, but most of it we just learned ourselves by understanding that how important we were to so many people, and we just wanted to get better and better at it. So that leads to then you break it down into, okay, now how do we do that? What's
Mhm.
most important? What are the drivers of the business? How are we going to measure it? And in our case, we determined what we thought was driving the business, and there was not a manager in the company that didn't know exactly what that was. And if we could move a number a little bit here and there, then that was important.
Yep. Let's jump to the end of the list, Alan,
Okay.
since time is running on. But um, we always say that the future is uncertain. You can't know it. It's not possible. And so you shouldn't even think like that. But you say that you can anticipate and plan for the future. So give us your philosophy and perspective on that, given the great experience you've had about a changing future.
Well, I think what bothered me, and I'll kind of maybe go at it in reverse, what bothered me about the way Blockbuster treated that all those years is that everybody understood that a video store was going to be under threat from some sort of technology at some point. And Blockbuster would pay that lip service, and they would say that whenever it happens, we'll be there. But they'd never invested in learning for themselves what that would be. It's like they would sit on the sidelines and wait for somebody else to figure it out. And because they didn't have much interest in it, they didn't understand what, like when Netflix came along and started doing things differently, they didn't understand it. The same thing happened with Redbox a few years later. Redbox comes along and opens up these little kiosks that nobody took very seriously at the time. But Blockbuster never invested up front in human capital or money to really learn where the consumer was going before somebody else figured it out first. And I guess it was virtually all talk, because there was no department in Blockbuster that looked at it. Very little money was allocated to it. So as Netflix and some of these other companies came along and started innovating in the business, Blockbuster didn't understand it.
Yeah. And one of the elements to that we always think is organizational design and organizational implementation. We like to talk about entrepreneurial empowerment, where you decentralize decision making and individuals like store managers can innovate and try new things, and that's fed back to
Yeah,
the center.
yeah,
One section of your book talks about the hierarchical structure of Blockbuster, and it was very CEO heavy. And they would hire these superstar CEOs from outside the industry, and
yeah.
they A, wouldn't listen, and B, did a lot of things badly. Just tell us about organizational design in your experience.
Well, I think I've always thought that regardless of how large a company is, it takes on the personality of the CEO.
Mm-hmm.
And in the case of Blockbuster, and probably don't need to spend a lot of time talking about all of them, but the primary one that was there running Blockbuster during the transformative years from 1997 to 2007, that was a guy named John Attiaco. He had learned retailing at 7-Eleven, and he had held a few more other jobs before he got to Blockbuster. But when John got there, he was very open. For about the first couple of years, he asked a lot of questions. I think he did a lot of things right, and then within a couple of years, he just disappeared. We never saw him again in a business setting for the last 8 years he was there, and then we would start hearing things that it was like that in the corporate world as well. There was only a handful of people that seemed to have any influence on what he was doing, as best we could figure, and that was confirmed in the research I did for the book. Uh,
Mm-hmm.
any communication from franchisees to John in the 2000s was just crickets. There was nothing. Nobody. He would never respond to anything. Uh, didn't have an interest in discussing the business. He left that, as he would say, he left that to the people he delegated it to. But the problem is he was calling the shots, and from my perspective, he was largely unengaged, and that was the opinion of a whole lot of people, not just me. So I felt like for the most part, the people that were closest to him were protecting him, and he was protecting them. It was kind of a mutual admiration society, and the interest in the business didn't go much outside their little circle.
So if you look at that through the lens of information flow, the information wasn't getting to him probably, and it certainly
and there's a lot. There's a lot of. I tell the story in the book of the person that opened the first DVD kiosk in the country. He made a presentation to the VP of Strategic Planning. As far as we know, that information never even got to John, or if it did, he ignored it, and they never had another meeting. And Blockbuster had an opportunity to be on the front end of the DVD kiosk business, but just ignored it. And a lot of it, I think, is because there just wasn't a flow of information in the company to go, okay, we need to take this seriously. They never did.
Well, Alan, this is a fabulous book. I really enjoyed reading it. It moves at a very fast pace. You're great at telling the story. There's such a lot of information there, but also there's an enormous amount of learning about how to cope with change and manage change and how not to. And those are equally important lessons, I think. And so we'll recommend it to everybody. We'll put a link on the site to the book. And I just got so much out of it. It was an exciting read. So thank you for doing it.
I'm glad you enjoyed it.
Good. Alan, thank you very much.
You bet. Thank you.
Economics for Business is a production of the Mises Institute. To explore more content like this, visit Mises.org. And for more from Hunter Hastings, visit hunterhastings.com.